You saw it clearly. Price tested the same high twice, rejected both times. You shorted with confidence. Then price swept the high, took your stop, and reversed exactly where you predicted. You were right about the direction. You were wrong about what the level meant. That high wasn't resistance. It was a trap that took two touches to build. By the end of this video, you will understand why equal highs and lows are not technical patterns. They are behavioral engineering mechanism. Why the second touch is more dangerous than the first. Not because the level gets stronger, but because your confidence does. Why the sweep itself tells you almost nothing. And what happens in the seconds and minutes after the sweep is where the real information lives. This is the dedicated breakdown of the concept introduced in the engineered liquidity video. If you haven't watched that one, watch it first. Stay with me. I am Bilal, the disciplined trader. This is episode 12 of the Operator SMC series. In the last episode, we established why liquidity must engineered before large moves can occur. This video is the dedicated breakdown of the most common engineering mechanism on your chart. Let's get into it. I didn't figure this out from a course. I figured it out after shorting the same equal high 3 times and getting swept every single time. Before I stopped asking why the level failed, I started asking what the second touch actually built. Here is the specific experience most traders have with equal highs and equal lows. They find a level, price has tested it twice, both times it rejected clearly. The structure is clean, the pattern is recognizable, so they trade it. They short the equal high or buy the equal low. They place their stop just beyond the level, and price sweeps directly through their stop, takes the liquidity, traps them on the wrong side, then reverses in the direction they originally predicted. Most traders eventually conclude one of two things: either equal highs and lows don't work, or they are being specifically targeted by market makers who can see their stop placement. Both conclusions miss the real mechanism completely because the concept is correct. Equal highs and lows do concentrate liquidity. The sweep does occur. The reversal often does follow. The problem is that most traders understand what equal highs and lows are without understanding what they do. They see the level, they don't see the behavioral infrastructure that makes the level mechanically significant. And the trader who sees only the level enters at exactly the movement the level was designed to trap someone who sees only the level. That is the problem this video solves. Not by giving you better pattern to trade, by changing what you see when you look at those two touches on your chart. Here is what most traders believe about equal highs and equal lows. They believe the level itself is what matters, that price rejected twice because the level is strong, that the second rejection confirmed their strength. That belief is precisely what makes the trap work. Here is the contradiction that changes everything. Traders believe the second touch confirms the level. Operators understand the level touch manufactures the confidence that funds the sweep. The first touch creates awareness. When price rejects a level once, traders notice it. Most remain cautious. Emotional commitment is still shallow. The second touch changes the brain, not metaphorically, neurologically. Human beings are pattern confirming creation. Repetition feels like evidence. The second touch tells your nervous system this is reliable, this is structure, this is something I can trust. And when the nervous system decides something is trustworthy, it increases commitment, it raises position sizing, it tightens conviction, and reduced uncertainty produces larger stops, larger breakout orders, more aggression entries, heavier emotional investment concentrated at a single location. That is liquidity, not created by the line, created by the confidence the line manufactured through repetition. Equal highs are not resistance, they are a repeated advertisement, and every time price returned to that level, it was building the confidence that would eventually destroy the traders who trusted it. In a moment, I am going to walk you through the complete formation sequence, how a valid equal high builds from the first touch through the third approach, and what the structure looks like while it's forming versus after it completes. But first, you need to understand the distinction that separates meaningful equal highs from noise. What makes equal highs meaningful? Here is the fact this entire breakdown depends on. The level itself never mattered, only the behavioral clustering around it did. And that clustering needs specific conditions before it's dense enough to be exploitable. Most developing traders treat every double touch as a liquidity structure. Their charts become cluttered with structures that carry almost no behavioral significance. The mistake is treating equal highs as a geometric concept when they are a psychological one. 5 conditions separate meaningful equal highs from noise. First, visibility. The best equal highs are visually obvious, the kind of thousands of traders independently notice without anyone pointing it out. Attention creates liquidity. Second, clean structural delivery. Clean structure feels safe. Emotional safety increases position sizing, and increased position sizing creates denser stop clusters. Third, time development. Liquidity strengthens with duration. More participants discover the level over time. More stops deposit above it. Fourth, compression into the level. This is the strongest real-time signal. When price compresses toward the level, candles tightening. Each approach more controlled than the last. Participation is densifying underneath the surface. Fifth, emotional storyline. The best equal highs creates a feeling. You can sense the market waiting. The psychological crowding is the liquidity. Without it, the structure is geometry. With it, the structure is fuel. If you cannot describe the emotional narrative, the structure created in the crowd, the structure likely does not carry meaningful behavioral concentration. The operator doesn't ask, are these highs equal? The operator asks, did the market successfully condition participants here? Now, the second touch mechanism. Now, the mechanism that makes the second touch the most psychologically powerful movement in the entire formation. After the first touch, most participants are cautious. Uncertainty remains high, then price returns, and something changes in the crowd that no indicator can measure. The second touch creates validation. What happened once might be coincidence. What happens twice feels like a structure. What feels like a structure feels like safety. Five things happen simultaneously. Reversal traders who entered at the first touch add to their positions. New reversal traders who were waiting for confirmation. Breakout traders build anticipation. Their buy stop orders accumulating just above the high. Existing short positions tighten their stops. And all of this happen organically. Thousands of traders independently making the same rational decision, collectively creating a concentration of executable order flow. That is what the second touch actually built. Not confirmation of a strength, infrastructure for the sweep. Now, I want to show you the complete sequence on a chart. The formation building, the sweep occurring, and most importantly, what happens after the sweep. Because the post-sweep behavior is where the actual information lives. Picture this on a chart. Price pushes into a swing high and rejects. A pullback follows. The level exists. Liquidity is thin. Now price returns. The second approach is slower, more controlled. Candles tighten as price climbs back toward the high. Price touches the same area and rejects again. Now the chart changes psychologically. Above those equal highs, concentrated order flow has been depositing for hours. Short stops, breakout buy orders, all sitting within a narrow band above those two wicks. Price begins compressing beneath the level. Candles tighten. The emotional tension visible in the structure is the behavioral clustering reaching peak density. Then the break. A candle closes above the equal highs with aggression. Short stops trigger and convert to buy orders. Breakout traders fire, FOMO buyers chase. A massive concentration of buy side flow hits the market. It looks like a breakout. It feels like confirmation. Now watch what happens next. The follow through does not arrive. The candle that follows hesitates. Price begins rotating back below the high. Then a displacement candle lower. Efficient, committed, accepted, with a completely different character from the spike that preceded it. The breakout traders who entered long are trapped. Their forced exit accelerate the move lower. The short sellers who covered in panic are now long at the worst possible location. And from the wreckage of that failed breakout, the real move begins. Clean, efficient, accepted. The equal highs were never resistance. They were the advertisement that built the crowd. And the crowd, confident, committed, concentrated, was the infrastructure that made the move possible. Equal highs are not resistance. They are a repeated advertisement. And every time price returned to that level, every rejection that made you more confident, the market was not confirming your analysis. It was building the confidence that would eventually destroy it. Because confidence is not edge. Confidence is liquidity. The more certain you became that the level would hold, the more capital you committed to that certainty. certainty. The tighter your stop moved, the heavier your position became. And all of that certainty, all of that committed capital concentrated at a single level is exactly what institutions needed before they could move efficiently in the other direction. You were not wrong about the direction. You were the infrastructure for the move. Carry that question forward, because here's exactly where it starts changing what you see. The perceptual shift this concept creates happen at a specific movement. It happens the first time you look at a clean double rejection on your chart, and instead of feeling confirmation, you feel a question forming. Who just became more confident because of that second touch? Where are their stops sitting right now? And then the deeper question, is this structure advertising itself to the crowd, or it is genuinely defending a value? Because not every equal high is a trap. Some work, some mark real institutional defense of a value area. The concept is probabilistic, not mechanical. But the trader who asks that question is no longer reading the level. They are reading the crowd around the level. The 2 weeks are not rejections. They are the visible footprint of confidence being manufactured. That perception doesn't come from a new rule. It comes from asking a different question every time a level forms twice. 3 mistakes that prevent this from being stalled. Mistake 1. Shorting the equal height directly. They've replaced one mechanical misunderstanding with another. Before learning the concept, they traded the level as resistance. After, they traded as a reversal signal. The entry location is the same. The result doesn't change. An equal high is a liquidity map, not a reversal signal. Knowing where liquidity is concentrated doesn't tell you what direction price moves after collecting it. Mistake 2. Entering immediately after the sweep. The sweep confirms liquidity was accessed. It doesn't confirm the real move has begun. After the sweep, watch acceptance or rejection. Does price accept back below the sweep level? The sweep created the question. Post sweep behavior answers. Entering at the sweep is entering before the market has answered. Mistake 3. Marking every double touch as meaningful. The concept is psychological, not geometric. Visibility, clean delivery, time development, compression, emotional storyline. These are the conditions that produce meaningful clustering. The filter is always behavioral, not visual. If you can't answer whether the market successfully conditioned participants at this level, the structure doesn't belong on the chart. Find 5 equal highs or equal lows from the past month. Clean ones for each one. Don't analyze the sweep on the reversal. Look at what happened between the first touch and the second touch. Study the approach. Was there compression? Did volatility contract? Then study the emotional storyline. What were breakout traders feeling? Where did short sellers place stops? You are not looking for entries. You are training the ability to read behavioral concentration while it's forming. Do that for 5 structures. Then open a live chart and ask the same questions in real time. The level was never what mattered. The behavior around the level was what mattered. Equal highs and equal lows are not patterns. They are the visible result of repeated behavioral conditioning. The footprint left behind when confidence was manufactured and committed capital was concentrated at a single location. The market does not react to lines. It reacts to the crowd that gathered around them. If this is the work you are doing, stay on this channel. New episodes 4 times a week, each one building on the last.